Welcome to Cash Flow Investing. My name is Matt, and this is the channel where we teach you how to invest, trade, and master your financial future through practical education and expert insights. Today, I'm absolutely thrilled to have with us Ricardo Martinez, a professional Forex trader with over 12 years of experience in the currency markets. Ricardo has traded through multiple market cycles, managed institutional accounts, and most importantly, has helped hundreds of retail traders transform their approach to Forex trading. Ricardo, welcome to the show.
Thanks for having me, Matt. It's great to be here and share some insights with your audience.
We're diving deep today into one of the most requested topics from our community: how to properly identify entry and exit points in Forex trading and how to read market sentiment. Ricardo, I know so many traders struggle with this. They might understand the basics. They've watched countless YouTube videos, but timing the market and managing risk seems to be where most people lose money. Size. Let's start with the foundation. Curious, what's the biggest mistake you see beginner traders make when it comes to finding entries?
Great question, Matt. The number one mistake is entering trades based on emotion rather than confirmation. Traders see a currency pair moving, let's say EUR/USD is breaking higher, and they fear missing out, so they jump in without waiting for proper validation. In Forex, patience is literally profit. Every entry should be based on what I call a confluence of factors, not just one indicator or a gut feeling.
Confluence of factors. Can you break that down for our viewers? What should they be looking for before they press that buy or sell button?
Absolutely. I use a three-pillar approach. First, identify the overall trend using higher time frames. If you're trading EUR/USD, look at the daily or 4-hour chart first. Are we in an uptrend, downtrend, or ranging? This is your directional bias. Second, wait for a pullback to a key level. This could be a support or resistance zone, a Fibonacci retracement level, typically the 50 or 61.8% levels, or a moving average like the 50 or 200 period moving average. Third, get confirmation from price action or momentum indicators on your entry time frame. This might be a bullish engulfing candle, a pin bar at support, a break and retest of a trend line, or RSI divergence.
So it's like a checklist: trend direction, key level, and confirmation. That makes sense. What about time frames? Should our viewers be focusing on specific time frames, or does it depend on their trading style?
It absolutely depends on your trading style. If you're a day trader, you might use the 1-hour chart for your entries, but check the 4-hour and daily for context. If you're a swing trader holding positions for days or weeks, you'd use the 4-hour or daily for entries and check the weekly for the bigger picture. The key principle is this: always trade in the direction of the higher time frame trend. If the daily chart shows EUR/USD in a strong uptrend, don't look for shorts. Look for pullbacks to key support levels to go long.
That's practical advice. Now let's talk about some specific currency pairs. What are your go-to pairs, and do different pairs require different strategies?
Great question. I primarily trade the majors: EUR, USD, GBP, USD, USD, JPY, and AUD, USD. Each pair has its own personality. EUR/USD is the most liquid pair in the world, so you get tight spreads and it tends to respect technical levels very well. It's perfect for beginners. GBP/USD, which traders call the cable, is more volatile. It can move 100 to 150 pips in a day, so your position sizing needs to be smaller. USD/JPY is excellent during the Asian session and is often influenced by risk sentiment. When stocks are rallying, USD/JPY tends to go up. When there's fear in the markets, money flows to the yen as a safe haven.
And what about exotic pairs? Should beginners avoid those?
For beginners, yes, absolutely. Exotic pairs like USD TRY or USD ZAR have much wider spreads, lower liquidity, and can be affected by sudden political or economic events. Master the majors first. Once you're consistently profitable with EUR/USD and GBP/USD, then consider branching out. But honestly, you can build an entire trading career just trading the majors.
Solid advice. Let's shift gears and talk about something that terrifies most traders, stop losses. Where should people place them, and how do you calculate proper position sizing?
This is crucial, Matt. Your stop loss is not arbitrary. It should be placed at a level that invalidates your trade idea. If you're buying EUR USD at a support level, your stop loss should go just below that support zone. Why? Because if price breaks below support, your bullish thesis is wrong, and you need to exit. Never place stops at round numbers like 1.1000. That's where everyone else places theirs, and institutional traders hunt those levels. Put your stop 5 to 10 pips beyond the obvious level.
So, it's about protecting yourself from being wrong, not about limiting your loss to a specific dollar amount?
Exactly. The stop loss placement determines your risk. Then you adjust your position size to match your risk tolerance. Here's the formula I teach. Let's say you have a $10,000 account and you're willing to risk 1% per trade. That's $100. If your stop loss is 30 pips away from your entry, you divide $100 by 30 pips to determine your position size. For Forex, you'd calculate $100 divided by 30 pips equals $3.33 per pip, which is roughly 0.33 standard lots, or 3.3 mini lots.
That's a game changer for risk management. Can you give us a practical example with a real trade setup?
Sure. Let's say EUR USD is at 1.0950 and it's been in an uptrend. It pulls back to the 50-period moving average on the 4-hour chart, which is at 1.0920. You see a bullish engulfing candle forming right at that moving average. Your entry is 1.0925, just above the engulfing candle. Your stop loss goes below the moving average and the low of the engulfing candle, let's say at 1.0890. That's a 35 pip risk. Your target could be the recent high at 1.1020, giving you a 95 pip reward. That's a risk to reward ratio of almost 3 to 1. These are the setups you want to take.
Excellent example. Now, one thing our community asks about constantly is market sentiment. How do you know when the market is bullish or bearish? What indicators or tools do you use to gauge sentiment?
Market sentiment is the collective mood of traders. Are they buying or selling, fearful or greedy? I use several tools. First, the Commitment of Traders Report, or COT report, which comes out every Friday. It shows what institutional traders and hedge funds are doing. If large speculators are heavily long on the euro, that's a bullish signal. Second, I watch risk-on versus risk-off sentiment. When the stock market is rallying, currencies like the Australian dollar and the New Zealand dollar tend to strengthen because they're risk-on currencies. When there's fear, traders flock to the US dollar, Japanese yen, and Swiss franc.
What about news events? How do you navigate things like non-farm payrolls or central bank decisions?
Fundamental analysis is critical for longer-term trades. For big events like the Federal Reserve's interest rate decisions or non-farm payrolls, I typically avoid trading 30 minutes before and after the announcement. The volatility is too unpredictable. However, I do pay attention to the overall theme. If the Fed is hiking interest rates, the dollar will likely strengthen over weeks and months. If the European Central Bank is dovish, the euro will weaken. You don't need to trade the news, but you need to trade with the prevailing fundamental backdrop.
That's a disciplined approach. So, combining technicals with fundamentals?
Exactly. Technicals tell you when to enter and exit. Fundamentals tell you which direction to focus on. For example, if the US dollar has a strong fundamental outlook due to rising interest rates, I'm looking for technical setups to buy USD JPY or sell EUR USD. I'm not fighting the fundamental trend.
Let's talk about exits. A lot of traders know how to get into a trade, but they struggle with knowing when to get out. What's your strategy for taking profits?
There are two main approaches. The first is targeting key resistance or support levels. If you bought EUR USD at 1.0925, you'd target the previous swing high at 1.1020. When price reaches that level, you take profits. The second approach is using a trailing stop. Let's say your trade is up 60 pips. You move your stop loss to break even, so you're risk-free. As the trade continues to move in your favor, you trail your stop below each new higher low in an uptrend. This allows you to capture bigger moves while protecting profits.
What about partial profit taking? Is that something you recommend?
Absolutely. I often take 50% of my position off at a 1-to-2 risk-reward ratio and let the remaining 50% run to a 1-to-3 or better. This way, I lock in profits while still giving myself exposure to potentially larger moves. It's a psychological win. You've made money and you're still in the trade. It reduces anxiety and improves decision-making.
Before we wrap up, Ricardo, what are the top 3 mistakes you see traders make repeatedly, and how can our viewers avoid them?
First, over-leveraging. Traders use too much leverage and blow up their accounts. Never risk more than 1-to-2% per trade. Second, not having a trading plan. You need rules for entry, exit, stop loss, and position sizing. Write them down. Follow them. Third, revenge trading. After a loss, traders immediately jump into another trade to make the money back. That's emotional trading, and it leads to bigger losses. Take a break, review what went wrong, and come back when you're calm.
Those are critical points. Discipline and risk management really separate successful traders from everyone else.
Absolutely. Trading is a business. Treat it like one. Protect your capital, follow your rules, and the profits will come.
Ricardo, this has been incredibly valuable. To recap for our audience, find entries using Confluence trend, key levels, and confirmation. Use proper stop-loss placement to protect your capital and calculate position size based on your risk per trade. Read market sentiment using tools like the COT report and fundamental analysis. And always have a plan for when to exit trades.
Thank you for having me in your podcast, Matt.
And to everyone watching, if you found this episode helpful, make sure to subscribe to Cash Flow Investing, hit the notification bell, and drop a comment below with your biggest takeaway from today's episode. Are you struggling with entries, exits, or risk management? Let us know and we'll cover it in a future episode. Remember, successful trading is about education, discipline, and continuous improvement. Keep learning, keep growing, and we'll see you in the next episode. Until then, trade smart and stay profitable.